Okay guys, so this is just a review of the trading room from yesterday, which was the 10th of January 2020. So this week's actually been pretty quiet on the FTSE. The global markets really have been consolidating in a tight range, so not many opportunities. So actually all the trades this week have been unofficial trades. So whenever we do an unofficial trade, it means it's not as high probability and only risk 0.5% on it. Orders don't take it. But I always give trading opportunities or talk around potential opportunities for those who are more experienced traders. If you're completely new to trading or a complete novice, then maybe just stick to the official trades. So what we were saying is that from the analysis always gives some sort of update as to why we're taking trades in the first place. So we're saying that, basically the market's positive at the moment because we haven't seen the market move below 75.20. So as a result of this, we're in a range between 75.20 to 76.40, and within that range there's a positive bias. So really, we're focusing predominantly on buys while we're still in this range, but you can still look at selling the market at the top of the range or towards the top of the range with a stop above 76.40. Okay, that's for your sell positions. Short-term direction, this gives you, if you're a day trader, this gives you basically, it just tells you that whilst you're above 73.80, you should really be focusing more on buys. Long-term direction, if you're a swing trader, you're looking at longer term positions, or you trade options, then this will help you. 5-minute bar, these are our system trades within the service. So we've got 5-minute bar, we've got spikes, and we've got the closing gap. The 5-minute bar I deemed as not worth taking yesterday. Spike up I wanted to go for, and the closing gap. The closing gap basically is where the market closed on the previous day. So on the 9th of January, the FTSE closed around 7,600. So what we're saying here is that when the market opens the next day, if it's opening above 7,600, then you have a closing gap to the upside, or if you're opening below 7,600, then you have a closing gap to the downside. And when we highlight the closing gap as likely to fill, wherever we open in the market, we're expecting the market to move back to the previous day's close, which in this example was 7,600. So actually yesterday we did have the FTSE as a likelihood of going back to fill the gap. Let me just see if I can actually bring this report upwards. Okay, you can see it now. So yeah, I won't basically highlight. I mean, most days I've got this as it's not a trade, but when I do say it's likely to fill, then you know you can go for the gap. So we just said here, good chance of filling if we stay below 76.53. So okay to sell the market with stops above 76.53. Now remember, why did I put the stop at 73.53? Well, it's above the top of the range. So remember, the top of the range is at 76.40. So it's a nice stop above the top of the range here, just in case we did take this level out briefly, which again I hadn't ruled out. I was thinking that it may just pop above 76.40 and then drop back down again. So let's have a look at the action. All right, so this is a 5-minute chart. This is the opening candlestick here. We can see the market opened at 76.23. Now there's various ways you can target the closing gap. Either you can wait for a spike up, which I like to do, which was actually in the report as well. We were saying that if it spiked up, we could sell the market. What I mean by spike up is wherever the market opens, if it moves up by 10 or 12 points, you can just sell it. It means you get an optimal entry into the market, and often you can have a very tight stop So you're risking a very small amount and the trade can complete very quickly. So often I will align the spike with the closing gap. So if I have a good feeling, or our full filter process identifies the gap is going to fill, then often I'll wait for a spike in the direction of the gap to get me into that. So yesterday we did have the spike. We didn't get the spike. The other way of trading the gap is to just sell the open. So whatever the open price is the market, you just sell it. And we know the stop was above 76.53, so the risk reward did make sense. You would have been selling at 76.29. Your stop was above 76.53, and you're targeting down towards 7600. So the risk reward makes sense there. Okay. And the other way, of course, is just waiting for a 5-minute bar break down. You could just wait for a 5-minute bar break to confirm the entry and then target the gap, as long as the risk reward makes sense as well. But you'd still really need your stop above 76.53 for that. So there's 3 ways of really targeting the gap, if I put that on the report, and it's something that you can consider. I did make the trade unofficial yesterday, so just 0.5% risk. As it happened, the market opened and pretty much went straight down to fill the gap. We opened here and the gap was down here at 7600, so just hit the gap and yeah, filled it. So that was yesterday's price action and the trade, unofficial trade. And then really actually we're waiting for non-farm payrolls, but that also had a negative reaction. So we're still really in this range. We're still in this 76.40 to 75.20 range. So next week we'll continue to sell high and buy low, most likely, until that range breaks. Have a great weekend. Hopefully you found that training video useful.